Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing the GEO Group stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. The GEO Group is a REIT that invests in private prisons and mental health facilities in North America, Australia, South Africa, and the UK. The company is headquartered in Boca Raton, Florida, and was founded in 1984. It went public in 94 and trades on the New York Stock Exchange, Mexican Bolsa, and Deutsche Börse. Its facilities include illegal immigration detention centers, minimum security detention centers, and mental health or residential treatment facilities. It also operates government-owned facilities pursuant to management contracts. It manages 95,000 beds at 129 facilities and provides community supervision for more than 210,000 offenders and pre-trial defendants. The US federal government makes up a little more than half of the company's revenues. It has been the subject of civil suits by prisoners and families of prisoners for injuries due to riots and poor treatment at its facilities. Let's get started with the model. This is a small cap company, 682 million market cap. They're trading at $5.57 a share, and they have 122 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. You can see that free cash flow grows a lot, from 80 million up to 333 million. That's a 4x growth. Net income is the profit and loss on the income statement. It's revenue minus expenses. That's pretty flat, from 145 million to 138 million. Revenue is the sales for the company, and that's pretty flat, from 2.3 to 2.5 billion dollars a year. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's pretty steady year to year. It did peak in 2019 at 617 million. That's also the year of their highest revenue, 2.5 billion. Below gross profit is operating expenses. Examples are marketing and depreciation. Gross profit minus operating expenses gives you your operating income, which is pretty steady each year, peaking in 2019 at 300 million. Below that is the interest they pay in their debt. They paid 150 million in 2018 and 19. It's down to 125 million in the trailing 12 months. Below that is other income and expenses. And if it's negative, it's usually an asset impairment. They have about $9 to $10 million a year from earnings from equity interest. This is their earnings from their investments in other companies. And the bottom line of the income statement is their net income, which is fairly steady year to year, peaking in 2019 at 167 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. So you can see they're generating over $400 million of operating cash flow in the trailing 12 months and 2020. Even though they only had $130 million of net income, that's because companies pass through a lot of non-cash expenses that bring down their net income, but it doesn't affect cash flow. When you decrease your net income, you save money on taxes. Then you have capital expenditures, which are investments in property, plant, and equipment. That's between $100 million and $200 million a year. So if this company bought a detention facility for $50 million, they would report the entire $50 million in their CapEx section the year they bought that center. But the $50 million would be depreciated over time onto the income statement. So for example, $5 million would appear as an expense onto the income statement for the next 10 years. Operating cash flow minus CapEx gives you your free cash flow. Their free cash flow grows a lot, from 80 million to 333 million. In 2018, they only had $80 million of free cash flow, so it looks like they added $200 million of debt that year. They issued $500 million and paid down $300 million because they have to pay their dividend payment, and it looks like they bought back $95 million of capital stock that year. When a company buys back capital stock, it decreases the shares outstanding, making your shares more valuable. In 2019, they had a good amount of free cash flow, so it looks like they paid down a little debt that year. In 2020, they added over $100 million of debt. Let's look at the capital structure. $940 million of equity, $3 billion of debt. They're 24% equity, 76% debt. Their net debt is $2.7 billion, and their WACC is 11.4%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $2.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.7 billion. We divide that by 122 million shares. And we get a calculated stock price of $22. They're trading at $5.57, so they're trading at a 74% discount. It's a really strong buy according to the model. Simply Wall Street always seems to be higher than me. They're at $24 a share. They're also saying the stock is undervalued. One analyst priced this stock, and their price target is $15. This top chart is the stock price since it started trading. It looks like it was fairly flat for a while, and then it was really driven up, well past $30 a share. But it looks like a lot of people took their profits and sold off the stock and really drove the price down. It looks like it's at a really low point. This is the stock price in the last year, so it's been coming down quite a bit. It looks like it's at a really great value. This company has been cutting its dividend a lot lately, from 48 cents to 34 cents to 25 cents. They said they're doing this to conserve cash and pay down debt, but their dividend yield is still really high at 18%. To calculate dividend yield, just multiply the last dividend payment by 4 and divide by the stock price. They pay out 88% of their net income and 37% of their free cash flow. So if you're looking for a really good dividend, look no further than this stock. They have a pretty low beta, 0.71, so the stock moves less than the market. The stock has gotten hammered the past 52 weeks, down 54%, while the S&P 500 is up 39%. The 52-week low was $5.46, the high was $15. And the stock is trading below its 50-day and 200-day moving average. About 3.7 to 4.4 million shares are traded each day on this stock. Of the 122 million shares outstanding, 116 million are on float, 79% are held by institutions, and nearly half the shares on float are shorted. This is a really highly shorted stock. In the past year, this stock has gone down 45%, while its industry went up 38% and the market went up 48%. In the past 3 years and 5 years, this stock is down a lot, while its industry and the market are up a lot. Analysts are forecasting their earnings to decrease 5%, its industry to increase 14%, and the market to increase 15%. Analysts are forecasting their revenue to decrease 5%, its industry to increase 6%, and the market 9%. In the past 5 years, their annual earnings decreased 1%, its industry increased 10%, and the market increased 12%. In the past year, their earnings decreased 9%, its industry decreased 11%, and the market increased 19%. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you would have been at over $30,000 at one point. But if you're still holding on, you'd be down to $8,300 today. That's a 17% total loss, a 1.8% annual loss. The biggest shareholders, Vanguard at 17%, BlackRock at 15%, State Street, then Invesco, then the CEO of the company. Let's look at their financial ratios. The average PE is 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 4.9, so investors are paying $5 for $1 of earnings. That's a really good PE ratio. Their price to sales ratio is 0.3, which is an amazing ratio. Price to book is 0.7, also another good ratio. And price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $941 million of equity, only $4 million of tangible equity, since they have $937 million of intangible assets on their balance sheet. Their return on invested capital is 6%. Their interest coverage ratio is 2.0. They have a great ROE at 15. And their current ratio is 1.7. Current ratio is current assets over current liabilities. Their current assets are $289 million of cash and $353 million of receivables. They do seem to be well capitalized. They had $333 million of free cash flow, $278 million of working capital, and $122 million dividend payment. So they have nearly $500 million of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 7 companies in the same industry as GEO, and if GEO has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. Funds from operations per share is an important ratio when looking at a REIT. Funds from operations is net income plus depreciation and amortization minus the gain or loss on the sale of real estate. So when you look at the price of stock over funds from operations per share, the lower the better. And they have a really good ratio of 2.3, the best by far of all the companies. Their price multiples are also really solid. Their current ratio is below average. They're higher in ROE than average. They have the most debt of all the companies. And in terms of market cap, they're the smallest company on this list, but they do pay the biggest dividend. To summarize, I have them trading at a 74% discount. When you have a company that takes government contracts, that's almost like a guaranteed revenue stream, and over half their revenue comes from government contracts. Their biggest presence is in the US, and in the US, we have the highest percentage of population in the detention system. I rank their free cash flows 8 out of 10, their revenue 7 out of 10, and their ratio is 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.